Welcome to the Remarkable Retail Podcast, our Season 9 premiere episode. I'm Michael LeBlanc.
And I'm Steve Dennis.
In this solo episode to kick off our new season, we'll be looking back a bit at summer months, dive into our take on all the big developments and big retail news that happened while we were away from our live show. Now, Steve, it's not like you and I spent much time apart. We had a ton of fun producing our popular Summer Insight series, but tell the people, how was your summer?
Well, since we were last on the mic, which was, I guess, the end of June, is that when we did that?
It's been like that, yeah.
It's actually been kind of quiet because some folks would know I was doing just a crap ton of travel, some of which involved you the first half of the year, but also stuff around the book and book launch and all that kind of stuff. But it's actually been pretty quiet for the last, whatever it is, 10, 11 weeks. Did spend a little bit of time with family up in Chicago, and I did do a brief little few-day break to Colorado, but mostly I've been basking in the Dallas heat.
A couple of highlights for me. I got a new barbecue. Of course, for those who know, that's a bit of a deal. I got a Spadini barbecue. You know what a Spadini barbecue is?
I only know because you've told me 14 times. But
little meat in a stick. Anyway, it's customized. I have to say, I cracked the code on how to master frits or fries without burning them. Short version, rinse like rice. There you go. Now,
there you go. Is that the episode title?
It might be rinse like rice. There you go. So reminder to everybody, we mentioned it just off the top that we had a 6-part or 6-episode summer series, which was very popular, but it's nice and evergreen, taking lessons from Leaders Leap and applying them to the retail industry. I had a lot of great feedback and comments from a lot of very interesting people about that. And what was your experience? I think it was, as we articulated, we always are telling people to try new things, and it was a new thing for us, right?
Yeah, I wanted to experiment with a different format. So, that was a little bit of taking my own advice. It's interesting, and I know you and I talked about this. I had, without going into too much detail, but I had this dream that another benefit would be, because we weren't doing news of the week, part of the reason why we're playing catch up here with this episode, we could knock these out because it wasn't based on time. And so, I would just like sit down and write the scripts, and we could record all 6 episodes in a weekend or something like that. And I could take July and August off. Well, turned out not to be, despite the best laid plans, it was a lot harder to really write these scripts as well as just be, just speaking myself without playing off a guest. So, it was a challenge. I think I learned some things, which hopefully will be useful. Other things probably not so much. But the other thing I think was hopefully useful, it's definitely some of the feedback I've gotten, is there's just a lot more advice in it. And not that we don't give advice along the way or use our guests to amplify certain pieces of advice or whatever. But it's a little bit more prescriptive, I guess, from that standpoint, and which I hope is useful. But the other thing that, if for people that haven't listened, and if you have, welcome your feedback on this, is framing up these questions at the end. Not only so people could try to take the lessons and make it more relevant to their particular situation, but also maybe have that be something you talk about at a staff meeting or a strategy meeting or a monthly operating review or something like that. So my hope was it's going to prompt some conversation. So it's not just here's 20 minutes of hopefully useful insights, but it's something that's got a longer life. So they're not time sensitive. You could listen. They're only, they're, I think, 16 to 20 minutes or something
snack size,
like that. So snack size. So hopefully people will go back and listen to those and share those.
Well, it's a great learning, the question part, because that's part of the Leaders Leap book, but I also experienced that in person. When I was last in Dallas, we had a member of the audience ask a question about basically, I see all this the way you do, but I'm not sure all my counterparts or leaders or the ELT team does. And these questions they found were just so useful. So I think it's a really valuable part of the series. Now, let's talk about what's in store for season 9. So it's a bit of a shorter season for us. We're going to go from, I guess we couldn't go as a shoulder season from the fall out to Christmas. Talk about what you see and what we're planning for the season 9.
Well, in a lot of respects, we're going to get back to our regular formula, our award-winning 5-star rated formula of the weekend news, and then most typically having a guest. We've already got quite a few excellent guests lined up. So we're going to have some C-suite executives from Warby Parker, Sephora, Birkenstock, a couple others we've got that we'll share at a later date. Also, of course, we often bring on top thought leaders. So, we've had Seth Godin, Scott Galloway, others in the past. Later, just in a couple of weeks, I guess, we're going to have Sucharita Kodali on, for example, from Forrester, who was our initial guest, as we're now a couple hundred episodes into this. So, stay tuned. But we'll be back into our normal rhythm, I guess, to the extent anything is normal anymore in retail.
All right. Well, let's get back into it. And as I was thinking of the session, I was thinking of our great scene from The Hangover.
We are back, baby. We are fucking back. We are back. Classic. We are back. We are back.
We're back.
We're back.
We are back.
There's also the poltergeist we're back thing. But anyway.
Well, there's that. I prefer anyway, they're both a ton of fun. Let's get into it. All right. What do we miss? What happened during the summer? Let's start with what seemed to be the battle of the behemoths continue, but also Walmart and Amazon. They're lighting it up and some, interesting and amazing things coming out of both those organizations.
Yeah, in some respects, I think this is the most interesting story of the summer because, obviously Walmart and Amazon get a lot of attention anyway, but here you have the two maybe best, but biggest retailers on the planet, quite mature businesses, and yet they keep putting up great growth and profitability numbers. So we see both of them gaining share, both of them putting up really good profits. Just to kind of double click on Walmart, as the kids like to say, not the Walmart part, the double click part. Their results over the summer and the last quarter were really pretty spectacular, particularly in the grocery arena. They've been the biggest grocer in North America for quite some time, but they continue to gain market share. Their customer base, traffic is growing. Again, being such a big retailer, pretty hard to get those numbers to move. Growth in media, growth in their Walmart Plus. I also think one of the interesting things, which gets a little bit to how they're, I guess you could say, neutralizing or going head to head more with Amazon, is their hybrid fulfillment system. What I mean by that is the way they're using stores to do online order fulfillment, whether that's shipping from store, local delivery from store, or customers coming to pick it up. I think that's the thing that's helping their profitability, because a lot of people, of course, struggle in online grocery. Maybe something we'll talk about a little bit later because of the fulfillment costs. So I think Walmart's really kind of firing on all cylinders there. Amazon, there were a couple of years there where they were reducing costs, closing distribution centers, kind of in the early stage of the Andy Jassy era. Jassy's clearly much more focused on profitability and kind of measured growth compared to Bezos. And, but, nevertheless, they're still putting up pretty good growth numbers, but really, really killing it on profitability. We're really seeing it. This is probably a whole other episode, but, and actually something we talk about with Sucharita in a couple of weeks.
Yeah.
I'll let people wait for that. But, as much as we think of Amazon as a consumer facing company, it's really much more of a B2B company in a lot of ways of thinking about it. Obviously, AWS is B2B, but so much of their fulfillment services and their ads business leverages the consumer-facing part to drive incredible scale and profitability in the B2B part. So we're just seeing ads in particular becoming a huge profit contributor. The other thing I think, we'll just continue to be talking about, we've been talking about it for years now, really, is where they're going with the grocery business. And just this past week, I believe, or maybe 2 weeks ago, they announced some additional Amazon Fresh store openings. So folks in general may know, and certainly longtime listeners would know, that they've been, opening stores, closing stores, trying different things. They're only up to 50 Amazon Fresh stores, so that's nothing in the scheme of the grocery world. But they continue to try things, not just with the store openings, but also playing around with some of the delivery fees and some other things. So, but I think overall, the two biggest retailers continue to put up good numbers. And I think later on we'll talk about kind of the concentration among winners and losers, but it's pretty darn impressive.
You know, one thing that caught my eye about Amazon this summer was their growth of their JWO, their Just Walk Out technology, and not in terms of their own stores, but in finding a home in sporting events, which has got this. There's a couple of them here in Toronto, but they've got a big expansion of that. So you go to an NFL game, you want a jersey, you don't have a lot of time. It's actually apparently is just driving sales, because that's the most frustrating thing about, you know, you're zipping out for a beverage or maybe get a great jersey, and you look at the line and you just turn around, and I think they found a real niche. I don't know if you call it niche, but that caught my attention as a long thought out use, because it was a grocery, right? They tried in grocery. It wasn't the answer in grocery. It just got me thinking about that.
Yeah, I think one thing that's hard about Amazon is, you know, it's an interesting learning because they try so much stuff, which is something, you know, we've been talking about and I talk about in both my books. But to say, well, you know, is this just sort of an interesting experiment that may turn into something big? But they've certainly had some things that they've tried that haven't had that potential, and they've either shut them down or, like you say, in this case, they found a different path that perhaps, you know, may end up just being a kind of interesting side business, or, you know, could be something much bigger. But I appreciate their stick-to-itiveness, I guess, and willing to pivot and just keep trying stuff.
Yeah, and their willingness to shut it down. I mean, that's a big theme for you as well, right? Just don't let it linger. You know, just it's not working, shut down, move on to something else.
Quitting is underrated.
Speaking of or transitioning, I guess, still within the e-commerce range, we've been talking about e-commerce for a bit. There seems to be this dichotomy, and it's not exactly new, but it seems to be accentuated over the summer, where you've got, you know, growth is but profitability but at the same time, growth overall is pretty important. It's pretty important to have a great e-commerce position.
Well, there's been a big debate, which I've waded into multiple times, around, first of all, this general idea of the great e-commerce acceleration. And again, I think if you look at one lens is to say, well, if you look at the actual data, and I know we've talked about this before, so I'll be quick. People that were talking about like 10 years of acceleration, you know, that is very, very clearly not close to being true. It's more like 18 months probably. And it's a little bit different by category. However, you know, that's still a ton of dollars, just objectively. The real takeaway is, obviously, digital has become more important. Obviously, e-commerce, I think, is going to continue to grow in just about every case faster than sales through brick and mortar stores. So you know, that's just one thing to kind of put in perspective. One of the things that I think has been really fascinating looking at the growth of e-commerce in the first 6 months is, first of all, e-commerce growth represents 50% of all growth in retail sales. Wow. So again, kind of, you know, to put it in perspective. So again, not this massive acceleration, but the incremental contribution from e-commerce is tremendous. The other thing is that e-commerce growth is quite concentrated. So if you think about, you know, the two biggest players in e-commerce are Walmart and Amazon. Their growth rates are considerably higher than the average retailer. So yeah, you can find a smaller player like Warby Parker or, you know, some other folks, but you know, it's just very concentrated how much growth is coming from e-commerce, and then it's very concentrated among a few players. So you know, a lot of other people are either struggling to get the right offering, I guess, for consumers, or the economics are proving challenging for them to be able to keep pace.
Let's talk about consumers and their behavior a little bit. I was just chatting with someone here in Canada, and we were talking about this flight to value, but he called it a stampede to value. One of our prior guests, Greg Hicks from Canadian Tire, called it a discretionary recession. And talk about you know, all the behaviors, the trading down, the selective trading down, the private labels. That seems to be taking a real point this summer.
Yeah, well, we've been talking about that. I mean, I don't know that there's a ton necessarily that's new here, because we've been talking about this probably for 18 months or so, that there is very evident trading down due to economic pressures. I think we're seeing that, you know, obviously, you know, I think the Canadian economy is more challenging than the U.S. So, you know, Europe different things in different countries there, et cetera. So it varies by country for sure. But generally speaking, most economies are not tremendously strong. And inflation in particular is causing a lot of people to try to find ways to save money. So we're seeing this trading down. So that's playing out by which formats are winning. So Walmart and Amazon and Costco and others, I think, are clearly off price, are TJX. Clearly, benefiting from this more broadly, though we'll talk about an exception a bit later. And then we're seeing it, within those retailers in terms of the price points that are selling. So opening price points doing better, private brands doing better. But even, on the higher end, and I think this gets more to the discretionary recession part of this. So even for people that have more money and tend to shop in higher price point retailers, we're seeing struggles there. Maybe not so much on the ultra high end like Hermes, but definitely in the more accessible luxury space. So if you look at pretty much all the luxury conglomerates, so LVMH, Kering, Capri, Tapestry, that have multiple brands in that. I mean, well, LVMH and Kering have some that are true luxury, but a lot of accessible luxury as well. The numbers are either quite poor or have weakened. So, and then, we continue to see pretty much the same pattern for, 2.5 years now, where big ticket home items are struggling as well. I think for a while we talked about that mostly as kind of the pull forward piece. I think at this point that's
still in place. I think
to a degree,
7 years,
but it's got to be less over time. But I think a lot of this is more tied to just pressures on people's spending power, but also just the home market, home sales and everything. So the overall perspective, I think, is we're going to continue to see. I don't see anything that fundamentally changes this flight to value and trading down phenomenon kind of writ large, at least in the near term. And if you look at what most retailers, not all, but most retailers said in their quarterly earnings that came out during the time we were off, most of them pointed to a weaker outlook going into the holiday season and into next year.
When you and I were talking off mic about what could change the momentum or change the course, and here in Canada, we've had 3 consecutive rate cuts in our interest rates. I know in the U.S., there may be one coming down the pipe, but it's not like that's our experience certainly is not like suddenly the next day people are, woohoo, let's go shopping. The rates have been cut by a few basis points. Like these are longer term things. I think it feels like a change management issue. Consumers got to get out of one habit, get into another. And I think, I don't think retailers are thinking, geez, we'll have a rate cut and then everything's going to be fine. So I think
I think that's a slow burn kind of thing. I mean, it's positive. Well, I mean, you could look at it as positive to preventing a recession. I guess that's one way of looking at it. Yeah. Or you could say, longer term, as rates come down materially, that will cause more investment. That will give customers more discretionary income. So, but I agree with you. I don't think it's going to be significant to the fourth quarter or the holiday, or even really the first couple of quarters of next year.
You mentioned an exception just now about results, and the exception you were thinking of, I think, was dollar store. So, dollar store results in a somewhat counterintuitive way haven't been that strong.
Yeah, I get a lot of questions. I've talked to several reporters about this, as well as just, friends and colleagues about, this flight to value, we'd think dollar stores would be amazing. Right. And it turns out they're not. And I think there's a few things going on, a couple of which we've touched on a bit in the past. So again, I'll try to be pithy about this, but I think if you look at how well Walmart, Amazon, and I would add Costco to the mix as well, at least in North America, they just have a wide assortment. They are not necessarily as convenient as dollar stores, but when you go head to head on pricing and you go head to head on one-stop shopping, that I think the data is pretty clear. They are winning overall relative to dollar stores. I think the second issue you have is there's just been so many stores open on the part of all the big chains. And I think they're just overstored. And I think that's got two effects. One is I think there's cannibalization from neighboring stores. So it's just harder to drive those comp store sales. And this is why I think one of the reasons, not the only reason, you're seeing, for example, Dollar General's closing, or Dollar Tree closing like 800 stores. So I think we're going to see a rationalization of real estate that's going to play out over the next year or so. But also I think, there's lots of examples of people basically dunking on some of these guys about how poor the execution is, how messy the stores are, et cetera. That may be a function of expanding too much and not having the management attention. It may be a function of difficulty in getting labor, because the labor market continues to be challenging. So I think there's a lot of executional issues that definitely aren't helping. So it does seem surprising, but I think it's relatively clear what the reasons are, some of which they can address by getting their store count better and focusing on execution, but some of it is a competitive dynamic.
So let's go guardrail to guardrail, so to speak. Let's talk about the big winners. So we've seen some numbers come out of some brands that are just eye-popping, literally. Right. So talk about that.
Well, it's it's easy to say, well, gee, things are tough, and it's hard to put up good numbers. But then facts are stubborn things, right? Because you see some companies there's several, but just quickly, I think the big rock star of the last quarter, but also really the last couple of years, is Abercrombie, putting up double-digit comp numbers in both their main nameplates. American Eagle,
retail turnaround, not of the year. I can't point to a lot of examples where a brand is near the brink and is turned around like that. It's hard to come up with them.
Well, it's incredible. And you could argue, they're not the cheapest out there. Apparel in general has been a tough business for just about everybody. So it's, I think, particularly impressive. The amount of market share they have grabbed is extraordinary. Similar to a large degree as American Eagle. We had Craig Brommers there, CMO, on the podcast earlier this year. Also very strong numbers, not quite as strong, but, both going after younger customers, affordable fashion. And for the other thing too is when we talk about challenges on the mall, most of these guys' stores are in the mall, so they're not only kind of defying the apparel apocalypse kind of narrative, they're defying the mall apocalypse narrative as well. And then you've got a few more focused players, like On Running just continues to put up amazing numbers. And you think, what can you do in the running category in the face of major competitors like Nike, Adidas, et cetera, Under Armour,
there wouldn't seem to be a lot of room there for growth within a big crowded category, but yet they're carving out some pretty aggressive growth.
And now getting much more invested in some of their own stores. So I think that's, people ask me sometimes, like, what are some of the brands to really watch? And that they would be definitely on my short list. And then Dick's Sporting Goods, which is, they had kind of a benefit from, not kind of, they did have a benefit from COVID in terms of people's, investing in fitness and things like that. Here again, fairly mature retailer, but just great focus, great execution, not opening a ton of stores, but investing in some new formats. And their numbers aren't, nearly as spectacular, I guess, as Abercrombie's, but really, really solid top line on profitability growth. So, even in the face of, and you would say sporting goods is, certainly more on the discretionary spending side of the equation. So, it's not impossible to grab market share when you've really got a remarkable format and execute it well.
Let's talk about the third place. Let's talk about Starbucks. I was fascinated, as I'm sure you were, and in fact, you and I talked about it, both from a leadership perspective and a business challenge perspective. Just a behemoth, 36, almost 40,000 locations. They went through an executive shuffle, very abrupt, actually. I think they went from an operator to a different vision and, a raft of issues and raft of opportunities. Let's talk about Starbucks.
Well, there's, I think, going to be one of the retailers to watch. They're always important because of their size and kind of part of being, their place in culture, I guess. But Brian Niccol, who's been the guy who's really driven great, well, he's got a really impressive career period. I knew him a little bit when he was here in Dallas, but kind of got really on everybody's radar screen with success at Chipotle. He's now moving over to see if he can work his magic at Starbucks. Starbucks, on the one hand, you've got the same kind of issues that we see with a lot of brands, Gap, perhaps we'll talk about them in a minute, where they get to be so big that it's really hard to maintain what made them special in the first place and get any kind of growth. So you layer on top of that, Starbucks, big investment in China. China's been difficult for pretty much everybody. So that's something that's they've had to deal with.
Well,
One of the really,
it's not, at best, it's not the growth engine it was, and that you'd think about the luxury, the LVMH. That's all. That tailwind is kind of dissipated for everybody, right?
for sure, right? So I don't think that's. I mean, you could argue maybe they shouldn't have gone so heavily in that direction, but anyway, that's not a Starbucks execution issue. The other thing that's been really fascinating with Starbucks is, and I've often featured Starbucks mobile platform or mobile app in my presentations as somebody who really understands kind of how you blend digital and physical, but almost there's too good at it, because the number of people that now order ahead to skip the line has really put pressure on their operations.
Yeah, the line's
really
bigger. The line's bigger for the order ahead now. Last time I went there,
yeah, it's just the stores were originally built out to be this third place where they want people to hang out, and so it's created a real issue in terms of their space and pressure on throughput. And now they're starting to do some digital only stores and reconfigure. But I mean, they're sort of a victim of their own success, and I think that's going to be interesting to see how they sort that out. I think the other big issue is inflation. I think you and I have talked a bunch of times. Like I have a standing meeting that I go to every week, or just about every week, and I always stop at Starbucks on the way, and I pretty much order the same thing. And my order used to be $6, and now it's almost $10. And it just seems like a stupid amount of money to pay for a coffee. It's not even a fancy coffee. So I think the value equation here, and just the general pressures on people is a huge issue for them. So we'll see if Brian can work his magic, but he's got a lot of challenges, and I think some of them are not so easily fixed if you actually want to be profitable, which presumably he does. And so we'll see.
We'll see. It's a fascinating strategy discussion too, because if you're not the third place, then what makes you different, right? Is it if you're just an efficient place, there's a location near me that's all it is a takeout, no seats, no nothing. It's just like another coffee store. That's I think an interesting discussion to be had. I wanted to throw
you're more McDonald's than than something unique.
Well, you're something different than what you were. Anyway, maybe they'll be successful being that something different. Hey, I wanted to throw one at you that we didn't talk about in our pre-work, and that's in the convenience store sector. We've got some, we don't spend a lot of time in the C-store sector. We had one couple of episodes, pretty interesting sector, with the big attempted takeover of 7-Eleven by a Canadian company, which is, really just could shake up the entire industry, particularly in the U.S. It's a Japanese company, 7-Eleven, but it's really a dominant player that Couche-Tard, based out of Montreal, is going after. What do you make of that?
Well, we usually say here in America that we have to watch the southern border because they're coming to take our jobs, but it looks like the Canadians might be coming to take our jobs.
Sneaking in.
It's funny because a lot of people think 7-Eleven don't realize 7-Eleven is a Japanese company, and particularly here in Dallas, because the 7-Eleven North American headquarters is here. People think of it as an American company, but it's very much not. But yeah, I mean, a lot of, seems like we're going towards more and more consolidation in a number of sectors. So, I don't have a good opinion as to whether or not this deal will go through. Certainly the kind of cross-border pieces of it create an extra dimension to some of the mergers we see, probably including one we'll talk about in a minute. But it'll be certainly could be quite disruptive if it goes through.
Let's talk about what do we say? False narratives or questionable narratives that you and I kind of hear. And one of those is I heard it last week from someone. He said, "Hey, there's been a big return to physical stores and these things." So talk about who's doing well. Is there a return to physical stores? And maybe that's as a kind of way to get into talking about the category we sometimes talk about, like there's been some activity in the department store category.
Well, this is probably worth a longer discussion, so I'll try to be brief. But I mean, if you look at the data in aggregate, traffic is up slightly to physical stores. If you look at growth in sales in stores, you'll see, as we talked about earlier, it's not very great, and it's largely concentrated in a few places. So like a lot of things, the devil is in the details. We're definitely seeing certain formats, as we talked about earlier, like grocery and off-price, do well because they are overwhelmingly their sales are overwhelmingly concentrated in physical stores. As that product mix shifts, that's going to favor certain kinds of physical stores. So if you back that out, you're going to see that traffic to everything else is down, I would say. That's one way of looking at it. There's also another thing which people often don't like to talk about, but part of the reason why traffic to enclosed malls is up, I would say, is it's really hot. It's, several degrees hotter across North America than it's been. So I don't know how significant that is, but I wouldn't discount that. But again, we have winning formats and plenty of companies that are opening stores, but we also have what looks to be an increasing pace of store closings more broadly. Some numbers from big retailers, Foot Locker's closing 150 stores. Macy's took their store closing from 50 to 55. Dollar General, as we talked about earlier, 800 stores. Pretty much all the drugstores, Walgreens, CVS, Rite Aid, closing hundreds of locations, some of which are still to be announced. So it really depends on where you sit. So I don't think the overall, whether retail traffic's up a little bit or down a little bit in aggregate doesn't mean very much. It's really a question of looking at which players. And then, of course, when you talk about Macy's closing stores or some of these big box closing stores, that's a lot of square feet, relative to, Warby Parker, Viore opening, 2,000 square foot stores. So the mix of the square footage and where it's located is also hugely important in terms of how it impacts people.
Last couple of quick things, and I want to touch on these for just a bit. They're definitely developing stories. So first of all, let's talk about Nordstrom. So the family putting down some money to take it private. What do you think of that?
Well, this is, they've made a couple runs at this in the past and haven't been able to pull it off. So we'll see if this was more successful. I suspect it will be, partially because of some of the way things have played out over the last year or so. But, if you look at Nordstrom, they've been kind of going nowhere for a number of years. Their most recent results were a little bit better than they've been, but their sales have gone nowhere. The stock price is down over the last few years. This time, and this is one of the reasons why I think it will happen, is they're partnering up with Liverpool, that some of our listeners may know is the big Mexican department store chain. If this goes according to at least what they're originally proposing, the Nordstrom family would retain 51% of the equity and Liverpool would have 49%. So
interesting structure.
So it's interesting in terms of the financing component. I mean, they're still presumably going to have a fair amount of debt. But given, kind of this strategic relationship and, not going out to work with private equity partners, at least I don't, that's not what I understand is currently on the table. And just kind of where the stock price is, I think there's a pretty good chance this would happen. Nordstrom still needs a growth strategy, and it's not obvious what that looks like.
Does it give them some wiggle room or give them a little rope to do what they might be wanting to do but are a bit constrained? So is it positive from their perspective?
Oh, I think there's definitely an argument. Well, first of all, I think doing this sort of deal, we'll see how much debt is involved, but doing this sort of deal without a ton of debt and being able to be out of the private or the public markets allows you to do things and, not have to be obsessed with meeting quarterly expectations. So as a family-run company, I think it's definitely got an advantage. Whether it will fundamentally allow them to really do something super interesting, not sure, but I definitely think private is preferred as long as you don't have to do like a big leverage buyout.
We've seen some improving numbers. Speaking of improving numbers for a couple of big brands, Gap, Target, and Best Buy. Is the celebration a little bit premature? It seems like just starting to be improving, but what do you think?
Well, I think it was funny both from the Wall Street reaction as well as kind of the media reaction of kind of like declaring success. Gap's turned around. Target's back, that kind of thing. And, as I often say, better is not the same as good. I think objectively, the numbers are better, but, even Target showing signs of life. I mean, they still have continued, even with the improved numbers, their numbers were considerably worse than Walmart's. So they're losing relative market share, and just objectively, their performance metrics are quite a bit short of where Walmart is. Similarly on some of these other players that have gotten a little bit more news. So I think it's encouraging for sure, but I would be careful to say that they're out of the woods yet. Because, in some cases, and this is important, I'm not saying it's not important, but, they're executing better. They're fixing known problems. But if the fundamental business model is disadvantaged, a little bit better, gross margin or lowering of operating expenses or, closing some unproductive stores, they make your numbers look better, but it doesn't necessarily, give you confidence that there's much of a turnaround. I would say, as I look at the numbers, Target's still a very good company. Best Buy's a very good company. I would say the Gap performance is more encouraging, but it's going to take more than a couple of quarters to say, Gap is really a remarkable retailer. But it's encouraging. I just would I'd maybe sit on the sidelines a little bit in terms of high-fiving and buying the stock and going crazy.
It's a great episode. Nice review. We'll be, as you said, as we've said, we'll be in our more traditional format, or this is part of our traditional format, having solo episodes.
We've got the great extended cut.
The extended cut. We got great interviews coming up, so stay tuned. But for now, let's leave it there. Thanks for tuning in. New episodes of Season 9 will be available each and every Tuesday, so be sure and tell your friends and colleagues in the retail industry all about us. If you liked our episode, please take a moment to give us a 5-star rating on Apple Podcasts.
And I'm Steve Dennis, strategic advisor, keynote speaker, and best-selling author of 2 books, Leaders Leap, Transforming Your Company at the Speed of Disruption, and Remarkable Retail, How to Win and Keep Customers in the Age of Disruption. You can learn more about me, my consulting, and keynote speaking at stephenpdennis.com.
And I'm Michael LeBlanc, consumer retail growth consultant and advisor, keynote speaker, and media entrepreneur. You can learn more about me on LinkedIn. Safe travels, everyone.